All right. Welcome everyone to today's line of credit webinar. My name is Craig Blodgett. I'm your partner advocate here at Loanspark. It's awesome to see you all. If you haven't, met me by now or connected with me, my contact information is listed right here for you. You can also find that in any of my signature blogs, and I send out regular emails, so definitely encourage you to connect with me at any time. My role here is to support the success of our partners, provide product education, any sort of status updates, deal updates, and guidance on the financing scenarios that you're looking to fund for your customers. So again, you can find my contact information right here or in the signature block of any of my emails. Today, we will be covering line of credit, specifically business lines of credit. So keep in mind, we are your business financing partner. We do not offer anything like a personal line of credit or any sort of card stacking. So for the purpose of this webinar, we'll cover business line of credit. So before we go any deeper, what is a business line of credit? Well, a business line of credit allows a business to borrow up to a certain amount of money and will only charge interest on the amount of money borrowed, sort of similar to how a credit card would work. A line of credit is unlike a traditional loan where you're given a lump sum amount of money and then you pay it back in installments. Typically, with a business line of credit, you have access to that capital, and then once you draw from that line, that is the repayment that you're making. Again, you're not obliged to use it, so it is more flexible than a loan or other types of financing. But once drawn, you can make those payments back, and then you'll regain access to that credit line as the balance re-increases upon successful repayments. Personally, it's my opinion that every business owner should have at least one open line of credit to allow for unforeseen expenses, cash flow challenges, or opportunities that pop up. So that's what a line of credit is. When should your customers consider using a line of credit? There are a few cases, the main one being that you can access funding whenever needed, right? So you activate the line of credit, it's very flexible, and now you have access to that capital, but you're not obliged to use it. A lot of the line of credits that we fund, the customer knows that he needs access to capital, but they don't exactly have a game plan yet about what exactly they'll be spending it on. So it's always better to have access to it than to not. Also, if they have short-term gaps in their cash flow, for example, you can activate the line of credit, draw against it when you need it, and leave it alone when you don't. An example of this would be if you're invoicing customers and maybe they pay late or maybe they pay on time, but at least you have that cash flow bridge in case a late payment does occur. If they need a low loan amount, typically we're seeing right now in the market 5 to 15% of annual revenue being an approval amount. So if your customer is doing about $1 million in revenue, we'd expect to see between $50,000 and $150,000 as an approval amount. There are other programs that can provide higher approval amounts, but if they're looking for a lower loan amount relative to revenue, line of credit would be a great option for them. Maybe your customer needs revolving access to capital. For example, as funds are repaid, the available balance will replenish versus a term loan where once the loan is repaid, it's over with. So think seasonal businesses, think trucking businesses that often have to make repairs and they need access to that capital in more than one time a year, right? Also, it would be a great use case if they need access to capital faster than a bank. I will go over this in a little bit, but I had a customer who actually needed to take advantage of an opportunity quickly. He wanted to go SBA, but just didn't work in the time frame. So if they need quick access to capital, line of credit is always a great option for them. And then it's great for paying short-term expenses or unforeseen expenses. Think inventory or repairs. If it's a longer-term expense, they may want to consider a term loan or purchase of a fixed asset, may want to consider equipment financing. But in the case of a short-term expense, lines of credit are always a great option to help them accomplish that. So we've gone through the what and we've gone through the when. Now let's talk about who would qualify. As you probably remember in our equipment financing webinar, Loanspark typically offers guidelines on required and preferred borrower criteria. Required meaning that's just what we need to see to get them in the door. Preferred ensures a higher success rate of approval. We're looking for 12 months time in business minimum, but we prefer to have a longer established business such as 24 months. Minimum FICO 600, but again, we would like to see 650 plus in order to ensure a higher rate of approval. We're looking for at least $10,000 in monthly revenues. However, we really like to see 35K a month or more, and we can work with all types of entities, but we prefer to work with LLCs or corporations. Some of the documentation requirements we'll be looking for would be basic credit application, government issued photo ID, 6 to 12 months of bank statements. The more that can be provided, the better. And then if it's a request over 100,000 or more, we'll be looking for financial statements and tax returns as well. Again, as a Loanspark partner, you're not required to provide all these documents up front. That's one of the reasons you partnered with us, is to get more deals done quickly without additional burden. So we will work with your borrower to collect these items and walk them through the process. So now we've officially gone through the what, when, and who. Let's talk about why you should be talking about Loanspark's products here compared to some of the other ones out there. But before we do that, let's break it down into a couple categories. We do have unsecured and secured lines of credit. The main difference being that a secured line of credit would be collateralized by some sort of accounts receivable or fixed asset. But the majority of customers that we encounter are looking for unsecured financing because it's simply faster, more streamlined, less underwriting steps along the way. So for the pros and cons, I will focus on unsecured. But if you have customers that you feel would be interested in secured lines of credit, definitely contact me one-on-one to discuss that. And keep an eye out. We may later on in the year go through secured lines of credit as well as a separate webinar. So going into the pros here, credit lines up to $300,000. Again, we can go up into higher amounts, as much as 10 million if it's been secured by an asset or some sort of invoices. These programs offer weekly and monthly payment options, which is great. And then returns are flexible. We go as low as 6 months up to 36 months as well. We have decisions as fast as same day. Again, it's important to make sure that the customer is responsive and engaged to make sure that we can actually abide by that timeline. But once the line of credit is activated, they will have funds available on demand. Typically, we see with the line of credit activation, the customer gains access to some sort of online portal. They can jump into the portal, make a draw, and receive it same or next day. They'll have access to a revolving line. Again, revolving meaning that as the funds are paid back, they regain access to that capital to use at a future date. So that's probably the #1 pro of line of credit versus any type of other financing. Your customers will only pay interest on the amount used. So if they don't need to use that whole amount, if they only draw a portion of that line of credit, they'll only pay interest on that. That's a huge differentiating factor versus a term loan. Whereas if you take a term loan out, you're paying interest on the entire amount, whether it's sitting in your bank account or whether it's being invested in the business. The application process is simple. It's a one-page e-sign that we'll send out to the borrowers, and then we'll just do a soft pull on credit to move it into underwriting. The only cons with this program are potential draw fees. We typically see 0 to 4% as a draw fee meaning that once a draw request is initiated, that amount would be deducted from the draw or just simply deducted from the available balance. Again, 0 to 4. There are programs we have that offer 0% draw fees, meaning no draw fee. So if that's a concern to your borrower, just let myself or the SMB advocate assigned to the file know that your customer is sensitive to that, and we'll work to find them the best program. There sometimes are minimum draws to activate. Some of our programs, based on the state that the customer is located in, may need to make a small draw from $500 to $5,000 to simply activate the line of credit. So again, if that's a concern, if your customer has absolutely no idea what they want to do with the funding or they don't want to make an initial draw, be sure to let us know. It's something we'll ask them, and we'll work with them to find the best program fit for them. I want to go through a couple of use cases with you guys here. Some of our recently funded deals that I think are worth highlighting. The first one being a customer that had spent 7 years in the food service industry. We got him a line of credit for $262,000. He was doing about $1.6 million in annual revenue. And the terms of the line of credit were 18 months on a 13.4% rate. We processed this in 5 business days, so it was fairly quickly given the loan amount. And the customer had actually spent the last few years running food trucks and restaurants in Texas. Most of the time, cash flow was not an issue, but when COVID hit a few years back, the business revenues drastically fell. And the owner was forced to take high interest short-term loans to make ends meet, which as we all know, a lot of business had to do that. After he finally got his head above water with those loans, the business owner wanted to make sure that he had a way to access the capital needed for cash flow challenges without having to take those types of loans again. So yeah, he came to us through one of our partners. We got him funded in about 5 days. And after activating that line of credit and being so impressed with our streamlined process and customer service and the terms we provided, he actually came back to us for additional lines of credit on other entities he owned. That way he can rest easy knowing he has access to capital to meet cash flow challenges in the future without having to do a fire drill if something happens and being forced into a unfavorable finance. In the other scenario that we recently funded, this guy, he was an owner of a growing e-commerce company. We got him approved for $121,000 on a term of 12 months. The rate was 19%, and his annual revenue was about 1.4 million. It took us 3 business days to get this done. And in this case, this owner of a growing e-commerce company actually came to his accountant, who had recently onboarded with Loanspark. And that accountant had announced on LinkedIn that she was offering new, diverse lending programs. So he came to her because he had a lucrative opportunity to cut costs and increase margins by purchasing inventory from overseas. He didn't have the down payment needed, though, to make a bulk inventory purchase from overseas. So he needed some capital because he couldn't make that order out of pocket. Initially, this customer was leaning towards an SBA, as many of our customers are, but he realized that an SBA loan wouldn't be able to get this done in that strict of a time frame. And then if he waited for an SBA loan, that opportunity may not exist once it gets approved. So he needed funding quickly, and he was already prepared with bank statements, tax returns, and financials. So in a matter of days, we were actually able to get this customer approved for that line of credit, which allowed him to capitalize on that opportunity and make the purchase order he needed to grow his business in a very fast and timely manner. Even better, the return on investment allowed him to pay back the draw balance quickly, and he still has access to that capital again for future orders or unexpected opportunities that might come his way. Those are a couple of use cases, but again, I've told you guys, I think almost every business owner should have a line of credit activated. We've done so many of these. I could go on and on about the amount of impact we've made through a line of credit programs. I'm going to open up the floor to questions here in a moment. I know we've run through this pretty quickly, but before we do that, let's go over some of our upcoming webinars. We've got a couple things lined up here. We've got a successful partnership one-on-one webinar in 2 weeks from today. We'll be discussing some best practices, the tools and resources at your disposal, and some strategies to help ensure this is the most fruitful partnership possible. And then after that, 2 weeks afterwards, on Wednesday, June 12th, we'll be going over term loans. Term loans are incredible tools to help businesses with long-term expenses. They often offer very favorable rates and are, I think, one of the most preferred types of financing for small businesses. So definitely be sure to tune into those. I think we've got some great things lined up here. They'll help you, and most importantly, they'll help your customers as well.